the markets are very expensive on just about every basis because we continue to overpay for earnings that don't deliver because economic growth is slowing, and that's going to slow again this year. So if economic growth slows, you're going to have less earnings growth. And at some point, markets are going to start to say, yeah, valuations at 27, 28, 29 times earnings, whatever it is, that's a bit expensive. We're going to have to reprice markets for underlying earnings reality, particularly if we have some event that comes along that, sparks a very rapid transition of that adjustment.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of another week, joined by my good and serpentine friend, the portfolio manager, Lance Roberts. Lance, how you doing?
Apparently you saw my tweet about Year of the Snake.
I did. And I got to give credit, actually. It was an eagle-eyed reader of your X feed who saw your tweet, then tagged me on it and said, hey, Adam, here's the word of the week for Lance. So I love it when people do my work for me. But yeah, let's actually talk about why you tweeted about the Year of the Snake, besides actually having been born in it yourself. But Years of the Snake are not typically blockbuster years for the stock market, correct?
That's right. The average return during so this is, if you're not familiar with what we're talking about, just real quick, these are the Chinese zodiac. So every year, there's a sequence of animals that relate to the specific year. And for instance, I was born in 1965. That was the Year of the Snake. My brother was born in 1960. Apropos, he was also the Year of the Rat, which is right. So snakes are charming, handsome, intelligent. So it's not, if you were born in the Year of the Snake, you have a lot of really good attributes going for you. But the Year of the Snake is not great for the stock market. On average, the Year of the Snake runs about a 0.8% return. So again, it's historically, again, these are averages. So got to kind of take that with a grain of salt. But on average, the return in the Year of the Snake is one of the weakest return years, kind of throughout history. So there you go. If you're a goat or a cat or a dog or a pig, you're in for good years.
Yeah. So not for nothing. First off, it doesn't seem that humility is part of the snake's characteristic set. But yeah, it looks like the worst year.
We're very humble. Yes, we are.
Yeah, but it looks like the worst years are years of the snake. Interesting. Okay. And funnily enough, stocks do better under horned animals. Okay, well, whatever. Okay, we probably scared away 2/3 of the viewers here now. Pardon me?
There's a lot to read into that.
Yeah. Like I said, we've probably scared away half the viewers already, thinking that we're now just guiding our stock picks from astrological data or astrological signs.
But Adam, this is what we do as investors. We're always trying to piece together some type of support, which in a lot of cases have nothing to do with the stock market. Zodiac signs, Super Bowl winner.
Sun flares, right?
Sun flare. Yeah, but things that happen every year, like the Super Bowl, right? We start trying to tie that to the markets. Oh, well, if the AFC wins, it's good for the market, or the NFC wins, it's good for the market, whatever. And look, a lot of that is just because a football team wins has nothing to do with the stock market. It just kind of turns out that there's a correlation to it, and so we start, kind of focusing on that as gamblers, right? Since we're addicted to the stock market and gambling, we're looking for any little edge we can get. And so now the latest is, of course, Chinese zodiacs.
Well, that and you say, humans, the way we're wired, we're always looking for pattern in meanings and things. Oftentimes things that don't have patterns or meanings. Also, we've raised many times, humans are not necessarily rational beings, they're rationalizing beings, right? So we see a correlation and we try to use that as the explanatory factor, right?
Yeah. One of my favorite correlations is, do you eat chicken, Adam? You like chicken?
Yes.
Yeah, then you shouldn't sleep in a bed because there's a very high correlation between people who eat chicken and those who die by getting tangled up in their bed sheets. So,
sure. Now, of course, what, 90+% of people eat chicken, so therefore, on average, 90% of people that get tangled in their bed sheets, eat chicken.
So, there's all these, these spurious, what they call a spurious correlation. It's just two unattached items in the world, and they just happen to correlate to each other. So these are called spurious correlations. And again, what does eating chicken have to do with bed sheets? Nothing. It just happens to have a very high correlation. But that's why, as investors, we have to really kind of come back and look at, okay, what actually drives the market? What actually has impacts on the market? A really good example is we've had a huge rally this week, right? Well, what caused it? Was it just because Trump was passing executive orders, or the fact that we had a very sharp increase in stock buybacks this week, which we did, after basically 5 weeks of negative buybacks? In other words, a declining rate of buybacks, which was why the market was declining. You had extracted a buyer from the market during the blackout period ahead of earnings. This past week, we had a lot of buyers coming back into the markets. JP Morgan, Bank of America, a lot of these other big corporations already announced earnings. Their buyback window is now open, and their Netflix, et cetera, they're back in the market buying stocks. You had a very sharp jump in stock buybacks this week. That is a correlation, because each of those have a direct correlation to each other.
Right. They have direct correlations to each other, but we don't necessarily know which one is actually responsible for it, right? So again, some people will look at this and say it's because the country, the world is becoming increasingly optimistic about the economy under the big, bold, actions that Trump is taking this week. And we're going to talk about some of those in just a moment. To your point, though, it could be much more just tied to, capital flows, right, with the buybacks coming on.
Well, again, and not to argue with you, but your first statement is sentiment. The actual second statement is money flows.
Yes.
What drives prices is supply and demand of stocks, right? So individual securities. So yes, at the end of the day, the only thing that matters is money coming into the market or coming out of the market. And since your net buyer of equities for the last 15 years has been corporations, it's kind of a good reason to understand why stock prices are going up. Now, when stock prices go up, we attach sentiment to the price going up. The sentiment has nothing to do with prices going up. It's the actual money flows into the market. But again, as rational human beings, we go, well, what's the reason? Well, we don't see the stock buybacks, but what we see is the headlines in the media. So we say, oh, well, that's why stocks are going up, is because, we passed these executive orders, we did this, whatever it was. But that's just us trying to rationalize why stock prices are going up. That's the sentiment side of the equation. The driver is the money flows, and that's buybacks.
Got it. All right. All right. So maybe we start early on, Lance, if you're able to pull up the S&P, because we have had a robust rise in the market here over the past week. So technically, what are things telling us? I mean, last week, the technicals were kind of telling us that stocks were sort of at this decision point. There was some there was a important price level that stocks had dropped below. They had recently punched back above that, and you were basically saying, look, this line has to now serve as resistance, and if it does, stocks should go a lot higher. But if it doesn't, they should turn back down. Looks like they actually punched higher.
Oh yeah. So so two things were going on, and just kind of recap where we were last week. Actually, let's talk about 2 weeks ago, just, kind of back it up. So 2 Fridays ago, we were talking about the fact that the market had been selling off really ever since the peak of December. This was where we were in blackout window for the buybacks. We had end of year distributions, kind of a lot of pressure on the market, money flow wise. And,
right.
And so we had negative money flows. This is that green shaded area in the background, which is money flow. So as money flows were declining and turning negative, again, this is exactly what I was talking about a second ago. This has nothing to do with sentiment. This is money flows, and markets follow money flow. So just is money coming in or is money going out? If money's going out, you don't want to be, that's where you reduce your risk to equities. That's why we were taking profits back in early December as money flows turned over. We started adding back money over the course of about 2 weeks ago. We started buying into positions, adding positions like Palantir, others to our portfolio that we talked about here on the show, because money flows were turning back positive. We were also triggering a MACD buy signal at the same time. And so with that buy signal in place, with money flows turning positive, that suggested that markets were going to rally. Now flashback to last Friday. So 1, 2, 3, 4, 5. Here's last Friday. We, to your point, we were challenging that resistance at the 50-day moving average, challenging that downtrend line from the December peaks, broke clearly above that. And then once you broke that resistance, it was an all clear sign to rally back to all-time highs. And we actually set a new all-time high as of yesterday. So we've had our first official new all-time high for 2025.
Okay. And what does this tell you technically right now? Does it look like animal spirits now have further room to run, given where things are going here, or are things looking a bit overextended?
Well, if we just take a look at, kind of where markets are, first of all, so the MACD, the moving average convergence divergence indicator, so that's this top indicator, that's really a measure of momentum. And that's turned up positive. We're not back to peaks yet. So there's certainly some more room to go here for another week or so. Now, if this market continues to rally over the next week due to earnings and buybacks coming back online, et cetera, we're going to start to approach, back to fairly overbought levels. Again, in relative strength, which is this bottom chart, is also not overbought yet. So we're getting there, but we're not there yet. So again, it suggests that we may get a little bit of sloppiness here. We've had a very sharp move over the last 2 weeks. That's great. It was interesting. 2 weeks ago, I'm getting emails from people panicking. Is this the Santa Claus rally failed? Does this mean we need to get out of the market? Is the market going to crash? And now it's this fear of missing out again. It's like, okay, well, we need to buy more stuff, right? How do we increase allocation? So this is a typical psychological response to markets. When markets are going down, nobody wants to buy anything. When markets are going up, they want to buy everything. So it's just this is the way we respond. But right now, the market could slop around here for 2, 3, 4, 5 days, kind of consolidate some of this recent gain. As long as you stay above 6,000, you're in good shape. The 20-day moving average should cross, that's that red line, should cross back above the blue line, the 50-day moving average. That will also confirm this reversal back to a bull trend. So again, so what the markets are telling you right now is there's nothing wrong with the market. Everything is fine. But I think once we start talking about later on in the year, and this was, by the way, thank you very much for coming to the Economic Summit last weekend. It was great to have you here. Enjoyed it very much. But that was one of the big things that we talked about in my presentation in particular, which was curbing your enthusiasm for later this year, because there are some impacts that are coming relative to earnings growth and expectations that will likely lead to a lower rate of returns this year. Now, that's not a negative rate of return. That's just not 25% or 20%. We're probably going to be talking about 8 to 10% rate of return sometime this year, with a good bit of volatility somewhere in between. So I think that's the one thing we want to keep focusing on, as we go from week to week here.
Okay. All right. Well, look, let me talk about where things may be headed from here. So one of the things that we've talked a lot about, I mean, in many ways, you say it's the only thing that really matters about where stock prices are headed is really what happens with earnings, right?
Mm-hmm.
And
Right.
we're now getting to close to earnings seasons for Q4, and as usual, Q4 2024 earnings have just been marched down, right? So now it's this low bar that companies will likely step over in their earnings calls and get rewarded for quote unquote beating expectations, even though initial earnings expectations were much more robust than where the final ones are, right? But you've talked about this before, millennial earnings seasons, everybody gets a trophy. I do just want to pull up this one image here. So basically, forward earnings are continuing to basically shoot the moon here, right? So we've brought down past earnings, Q4 earnings. They're going to step over that bar easily. But forward earnings, are continuing to be exceptionally rosy here. So you have mentioned, and we talked about this at your conference, and we're going to talk about the conference a little bit in a second, but that entering 2025, you seem to be more concerned about valuations than I think you have been in the past 2 years. And as I dug around with you on why, I think it's because, if I understand you correctly, it's that you're having a harder time seeing how the rosy earnings expectations are going to get met this year versus past years, or the delta between expectations and what you think reality will deliver is going to be harder this year than it's been in past years.
Well, and that's because you have to come back to the very basics of how earnings are derived, right? Where do earnings come from? And this is the one thing that seems to elude most Wall Street analysts, I guess, is they just kind of put out there. They just say, okay, well, earnings are going to grow at 15% this year, and that sounds great. And look, they're marketing, right? So let's just they're not actually publishing earnings estimates based on any type of factual reality. They just kind of put a number out there that's a good marketing number, helps support their underlying thesis because they got to sell product, and that's the important thing at the end of the day. But just like last year in 2020, so in 2023, everybody expected earnings to grow by 19% for 2024. It grew at 9. So, but we don't go back and look at the revisions and those type of things. Well, this year they're expecting earnings to grow near that same rate this year. But step back for a moment, where do earnings come from? They just don't magically show up, right? They have to come from somewhere. Earnings are what happens at the bottom of the income statement, not the top of the income statement. At the top of the income statement is revenue. Revenue is what comes from sales. And so if I'm, it doesn't matter whether I'm Meta or whether I'm Google or whether I'm, Black and Decker or Raytheon or any other company in the markets, my job is to go sell product. And if the economy is slowing down, if the consumer is slowing down, and we know that on multiple levels from just looking at economic data, then the revenue is going to slow down. Because again, people are just spending less. That's why economic activity is slowing. They're running out of stimulus money. So as all that influx of capital from the Inflation Reduction Act, the CHIPS Act, all that kind of keeps going through the economy, economic growth is going to slow. Revenue at the top line is going to slow. And that's why we have to keep coming back and ratcheting down quarter after quarter. We've got to ratchet down these expectations that we thought we were going to meet at some point, but are not actually getting there. And so you keep having these, and here's a good example. This is quarter 4 that we're in right now. So we started out in quarter 4 in March of 2023. They estimated that at the end of this year we'd have $227 in earnings, and we're gonna print out about 209 at the end of the day. So we're gonna cut nearly $20 in earnings. Now remind you now that markets are dramatically higher today than they were in March of 2023 when everybody was buying it based on $227 in earnings. So you overpaid for those earnings by $20 a share to wind up with 209.95. So, this is the problem that investors have. And this is why when you take a look at valuations in markets, whether it's price to sales, price to earnings, whatever it is, the markets are very expensive on just about every basis because we continue to overpay for earnings that don't deliver because economic growth is slowing, and that's going to slow again this year. So if economic growth slows, you're going to have less earnings growth. And at some point, markets are going to start to say, yeah, valuations at 27, 28, 29 times earnings, whatever it is, that's a bit expensive. We're going to have to reprice markets for underlying earnings reality, particularly if we have some event that comes along that sparks a very rapid transition of that adjustment.
Right. And it's increasing that kind of fear. It's going to be some sort of emperor has no clothes moment where investors just say, wait a second, we've just been way too excessively rosy on forward earning potential, and we're going to just have to ratchet it back, right? Because to your chart there, people were happily buying the S&P back in 2023 based upon the forward earnings because, they're going to be so great. They're going to be $227 or whatever, right? Now they're happily buying the S&P because, look, we beat the adjusted expectations of 209, right? So no matter what happens along the way, even though earnings expectations are coming down, the news is interpreted as good, right? And so at some point in time, someone somewhere is going to say, you know what? We've been fooling ourselves for too long. I'm out. And then everybody's going to say, oh, geez, I better be out too.
Yeah, and look, here's a really interesting chart about this. So all this chart is just forward earnings expectations based on trailing 12 months EPS versus forward operating earnings EPS. So the red line is forward operating PE, right? And you can see that very big deviation right now at 25 times forward earnings versus
Okay.
21 times
Wait,
earnings.
wait a second. You said the red line was forward. It looks like it's reading trailing on your
Sorry.
computer.
I said that backwards. Sorry. Red line is it's a trailing versus forward. Forward is always more optimistic. Okay, so forward operating earnings is always much more optimistic. So the valuations are lower because I go and I peg out. I say, okay, we're going to have $250 a share in earnings this year. That's the expectation for 2025. And at 6,000, that's a much better PE than where earnings actually are on a 12-month basis versus valuation. So, but the important part about this is that the trailing reported PE is always above the forward PE, right? Because again, it's optimism versus reality. But also notice that trailing PE always catches down to forward operating PE.
Mm-hmm.
So again, that optimism, that spread, this is just basically another measure of sentiment. I could just maybe I'll do this. I'll just create a spread, a deviation between these two valuation measures. But when you get that reversal in reality, trailing PE will catch down to forward operating PE. Forward operating PE never catches up to trailing. It never happens. It will catch down eventually, and that'll be the moment that people start repricing kind of for reality.
Okay. What'll cause that? Obviously, we don't know, but that's one of the reasons why we track this on a week-by-week basis. So those charts might have come from your recent article, Lance, but this is sort of what I was teeing up with my initial chart and questions there. You recently wrote a piece titled "Are Return Expectations for 2025 Too High?" That piece used a lot of the charts you walked folks through at your conference last week.
Right.
Any other things you want to say about that? I mean, just based upon what we've been talking about here, seems like your answer is, yeah, probably they're too high.
Yeah, and I've actually got a couple of articles that I'm working on right now that all kind of relate back to the same kind of structure and the same kind of thought process. Just really kind of looking forward into this year and suggesting that we need to maybe be a little bit more cautious about our outlook. And there's just a lot of factors. And again, let me be really careful in what I say here. I'm not saying the markets are about to crash. I'm not saying that the good times are about to end and you should be in, cash and gold and beanie weenies in a bunker somewhere. I'm not saying that at all. What I am saying is that the ability for the markets to continue to print 20% rates of return is probably extended. And we need to start kind of tailoring our expectations back to expect more volatility, expect some drawdowns this year of 10 to 15%. Certainly wouldn't be outside the realm of normality. A 10% decline in any given year is perfectly normal. So we need to manage for that potential risk and understand that it's out there, but that doesn't mean that we shouldn't be invested because markets are doing fine right now. And there's nothing at the moment to suggest that markets won't continue to do well this year. But I think we need to be at least a little bit cautious about more exuberant expectations because those tend to not work out as well.
Yeah, and just to be clear, I sort of teased you a little bit at the conference that your symbol is the eagle and you aspire to be the eagle who's above the world of the bulls and the bears and just watches what happens. But, I asked you, hey, is the eagle beginning to grow a little bit of fur and some claws? And you guys basically said, hey, look, we're still investing. We're still invested. We have barely altered our equity exposure so far. You have a smidge, it sounded like, but just barely. And so we talked about the analogy of whether it's the dance floor or the movie theater. You're still in it. You're still enjoying the music or enjoying the show, but you are kind of positioning yourselves a little bit closer to the door just in case you need to make some portfolio changes pretty quickly. You're going to be at the ready to do so. But for the time being, it's still business as usual. And we talked about some of the things that you're going to look at to let you know when the system is starting to show signs of concern, credit spreads being a key one of those. And you're not seeing very many, if at all, like imminent warning signs yet.
Right. And like one thing I'm watching very closely right now is foreign inflows. We've had a super strong dollar this year, which had
Foreign capital inflows, correct?
foreign capital inflows, right? So we've had just a super strong dollar this year. And that's because foreign inflows into the US are just piling in just as rapidly as they can. And we have a record level of inflows into the U.S. over the last couple of years in particular, and that's been a big contributor to some of the rise in the market. But we're now at levels on those foreign inflows that, well, we're basically at a record. And so one thing to watch very closely is to start looking to see if we start getting a reversal of those inflows, because again, why do markets go up and down? Right. At the end of the day, forget all the other stuff. And I was talking about this on my radio show the other day, that we podcast on YouTube, which is forget your thesis. I don't care, whatever your thesis is, you should throw it out the window. It's housing, it's the employment market, it's this, it's the deficit, it's whatever. Throw all that nonsense out the window, because that has nothing to do with how markets work. Those are the rationalizations that we attach to markets. And the reality in all that drives markets, like we said before, is just inflows. So if you just watch inflows and where money's coming into the market and where it's going out of the market, it tells you all you need to know. And you can watch that through credit spreads, you can watch it through capital flows, et cetera. And right now we have just a massive inflow of money coming from buybacks and foreign investors that are driving markets higher, because we're the only source of investment place really to put money. I mean, do you want to have money in Europe right now? No. Do you want to have it in China? No. They're dying at the moment. Japan's struggling left and right, so you don't want to have money over there. So if you don't have any other investment options, where are you going to put it? Right? You're going to put it in the U.S. And so right now, and this is what we're talking about before, is we're just like this big Hoover vacuum cleaner, just sucking up capital flows. But that'll change at some point. And so when those flows start to reverse, then that's going to extract capital from the U.S. markets, and that's where things are a little bit more challenging. But
Right.
Kind of that happening right now. That's the whole point. It's just these are the things to pay attention to.
So there's that old adage, which is very correct, which is that capital goes where it's best treated, right? Right now, it's being best treated in the U.S., and everybody's trying to get there. I grew up in little sailing towns, Lance. So, to me, I just sort of think of this as like, boats in a harbor, right? Why do they go up? Why do they go down? Right? It's because the tide's either coming in or the tide's going out, right? I mean, very simple at the end of the day, right? So you're basically saying markets are the same thing. To your last point there, I want to just, we're going to talk about Michael Howell in a moment, because I just interviewed him this week. It was fascinating and great to get an update from him. And again, he's all about liquidity, which is more or less the same thing. But when I was interviewing Grant Williams, probably about a month ago or so, he was basically saying, he was commenting on this and saying, how long will this continue? Who knows, right? And somewhere, Brent Johnson's doing a well-deserved victory lap, right? He's talked about this a lot. But Grant is basically saying, he is starting to think about positioning for the time where, as we say, sort of cure for high prices or high prices, right? At some point, U.S. stocks are going to become so overvalued that you just can't justify them, right? No matter what the capital flows are doing. And the rest of the world is going to be so damn cheap, right? Like, are they the world's best companies? Are they in the world's best countries? No, but at a low enough price, it becomes a really attractive investment opportunity, right?
But you've got to be so careful with that statement, though, because we've been hearing for the last decade.
Sure.
Oh, you got to invest in Europe. You got to invest in emerging markets, BRIC countries. Those are going to be they're cheap relative to the U.S. And those are going to boom next year. And this has been a recurring thesis for the last 15 years. And those have been your biggest underperformers. So what's really important about this, and this is the one thing that people don't do, is they look at relative valuation. So they say, Germany is super cheap relative to the U.S. And it is, because you look at, our PE ratio versus their PE ratio. But Germany is not cheap relative to itself, because the German economy is on the brink of recession. Its valuations are cheap for a reason. And that's why capital is not flowing those countries. And yes, someday that may turn. But again, you take a look at the demographic issues of Japan and Europe in general, not to mention what's going on in China. Those big drivers of economic development, which is ultimately what drives valuations and earnings, are not good, and those valuations are very expensive relative to their own countries. So yes, on a comparative basis, just to look at us versus them, yeah, they look cheap, but there's no reason to drag capital over there. You don't want to invest in those countries because there's no economic activity.
You don't want to invest in a bad company with bad prospects. Totally get it. And I
Yeah.
was sort of working up to somewhat of that caveat, but to the bigger point, which is the U.S. market seems to be on its way, right? If the trajectory doesn't change, to becoming unsustainably overvalued, right? And as a
Yeah,
capital,
but what value is that? What do you mean unsustainably overvalued? We've been overvalued for 30 years,
right? But
right?
we have this that we so capital keeps coming in here. It's pushing up valuation metrics, right? Forward PE ratios, that type of stuff, right? We just talked about how there'll probably be some corrective moment at some point here. Now, maybe that's just a blip on the way to even higher stuff, but at some point that trend will end. Is it going to be this year? Is it going to be 10 years from now? We don't know. But my just question to you as a capital manager is, if you're looking at that, let's call it a valuation balloon that's getting more and more inflated, how are you, if at all, saying, okay, if this does get too rich, right, and the capital starts having to flow elsewhere, how are you determining where it might go and potentially thinking about positioning when that time happens?
Well, again, you're making some very broad assumptions that have no basis, right? You're saying that just because I blow up a balloon doesn't mean it's going to pop, right?
Mhm.
And so what you're making the assumption is you're going, okay, the balloon is blown up, so it's eventually going to pop. It has to. It always has to pop. And I'm not saying that that's not the case, right? But you're making assumptions that don't necessarily fit into how markets actually work.
Okay, let
Because,
me just clarify one thing you said there. I'm not necessarily saying the balloon has to pop, but I'm saying
but when you say
capital flows can't go in one direction forever.
well, you say that, but they could. There's nothing necessarily that deters capital flows if the U.S. economy is. Let's just make some wild assumptions for a moment. The U.S. economy continues to grow at 4 or 5%. We're the AI hub center of the world. We're the cryptocurrency center of the world. We return back to the 1940s, 50s, because again, now one of Trump's kind of mantras is the return to the space race. Most people don't realize, because they're not as old as I am, that most of the things that you enjoy in your life today, from your microwave oven to your vacuum cleaner to your television to your radios, a lot of that stuff that we enjoy, the cell phone is another good example. Though a lot of those products, a lot of that technology was derived from the 50s and the 60s, when we were in the midst of the space race to get the first man to the moon. Now Trump is talking about being the first country to get people on Mars. So it's a return back to this idea that we're going to innovate to create a new trajectory for the country, right? It's this return to a manufacturing innovation world. And remember, this was the big driver in the 80s and the 90s, was all the innovation that occurred in the 50s and 60s from the space race that just led to all these other
Right.
inventions, the computer,
Internet being one of
all
them.
the other
Yeah.
things that we have. And so a lot of the technology that we have today came from that period of innovation. So now, this is where I'm getting to your point. If we turn back to that era, and again, we're just gonna say the US is the only country doing it, right? We're just gonna make some assumptions here. There's no reason that we're not going to continue to suck in capital flows for 10, 20, 30 years, depending on how long this lasts. So my only point is saying, be careful with the statement that it's unsustainable. Be careful with the statement that it's going to end, because it may not end in our lifetimes, right?
Yeah,
That's
that's very fair. And I think it's a great point where we all think things have to happen. And we may be right that they do. It's just the timeline they happen on might be so long, it doesn't matter to us as investors. Let me just
yeah.
ask the question one last time, which
Sure,
is,
that's what I'm about to get to your answer.
okay, but yeah, but
Go
just to
ahead,
box,
but
pardon me?
reframe the question because we got off tangent. Go ahead.
Yeah. The question is just, yeah, if you, as more and more capital comes into the floods into the U.S., I think as a capital manager, you have to say, all right, look, this is the getting's good right now, right? It's pushing asset prices up, but that may not last forever. And
Mhm.
I, as a capital manager, need to be aware that, that trend could reverse. And if so, I want to be positioning for it and putting money elsewhere. How are you thinking, if at all, about identifying what to do if that trend changes?
Yeah. So this was kind of, kind of a point I wanted to get to. So first of all, valuations are extremely elevated. You can see this chart, right?
Yep.
Okay. So this is the S&P 500 going back to 1871 versus valuations. Obviously, as price rises, so do valuations. And to your point, Adam, right? Previous periods of excess valuation, normally at 23 times earnings or a little bit higher, you had very bad outcomes. And these are those valuation reversions that we have, dot-com crash, the pandemic, et cetera. We're very deviated from the kind of a long-term trend in the markets, and this is something that we want to be really aware of. So this is basically the market deviated from its long-term exponential growth trend and valuations, its relative valuation to that deviation. So again, we're 147% above our long-term exponential growth trend. The only other time we've been this high was back in the early 1900s. So, there's certainly, to your point, and again, I'm not, and this is why, this is important. There is certainly reasons to expect that at some point the markets are going to start to question the valuation assumptions that are being made, and particularly in this environment. Now, importantly, we have shifted, and this was my point to you earlier, is that we have shifted the median valuation higher over the last 40 years. Used to 15 times earnings was kind of the median valuation. If you were at 23 times earnings, that was really very expensive in the market. That's no longer the case. We have now shifted that median and the average up to about between really 17 and about 23 times earnings. So a valuation reversion today, and this is where a lot of people kind of make a mistake, is they go, oh, well, when we get back down to 10 times earnings, I'm going to buy the US. We may never see 10 times earnings again.
Right. You don't think it's necessarily going there. Yeah.
Right. So we may see, a valuation reversion, but it doesn't get you back down to these disastrously low levels. And that was kind of one of my recent articles talking about valuations next year, and looking at possible ranges of returns. And it all depends on where we wind up valuation wise. And a valuation contraction is the thing to think about. So now, to answer your question specifically, as a capital manager, what we're looking for is, again, we're watching inflows into markets. Where is the inflows coming from? Here's a couple of numbers for you. We're going to do $1 trillion worth of stock buybacks this year. That's just what's announced so far. I fully expect that to be about 1.2 trillion by the time we get into mid-year. So we're going to have a massive inflow of capital from just U.S. companies buying their own shares back. That's a major support for the market. So that can certainly keep prices elevated and valuations for a while. But if that reverses, if stock buybacks begin to reverse, that's going to extract capital from markets. So that's going to be one of those things we pay attention to. And foreign inflows, as I said earlier, that's going to be a big reason. If we start to see the dollar decline sharply, that's going to be something you want to pay attention to. The markets respond well to a stronger dollar because that's showing capital coming into the markets. That's driving the dollar up. So if we begin to see a much weaker dollar for whatever reason, that's going to certainly be a warning sign to pay attention to. So if we begin to see that happen, then we're going to look at, where is money flowing to? What are we seeing as opportunities, to place capital where that's happening? But to your question, Adam, specifically, this is where, and I've shown you this, on the show before, but on SimpleVisor, one of the analyses that we have is that we look for relative and absolute performance of both just sectors of the markets, but also factors of the markets. And this includes, where's money flowing to, what's overbought, what's oversold, and what's changing. And so this is a short-term analysis. So this is what happens near term. But, like lately, we've seen a lot of money go into more speculative investments. And so this is why ARK has been really kind of the leader of the market over the last couple of weeks. It's extremely overbought now. So I would fully kind of expect a reversal out of some of these meme stocks. back into other areas of the markets. Low value, low volatility, value stocks, they've been massively underperforming. Emerging markets, massively underperforming. So, if we begin to see a shift within the markets, that's going to start to tell us a lot about where capital is flowing to and kind of what to expect over the course of time. And we can pull this analysis a little bit further and look at relative performance over periods of time. And so what this analysis does is it looks at all those same type of factors. And so it looks at, value versus growth, emerging markets, international momentum, mega cap growth, high dividend yield, and looks at the performance over the last 20 days, the 20 days after that, the 20 days after that. So going back in time, we can look back over the course of basically the entire year or more, and I can just change the variables that I'm looking at. But I can see that, over these kind of longer periods, you can start to see if money is rotating from one area of the market to another. And as you begin to kind of watch that rotation, you can see where capital is flowing to. And so far it's been, and this is not surprising, so far it's been in large cap, mega cap. That's where most of the money's gone into. High beta stuff. Emerging markets have been kind of grossly underperforming for a long time. Small cap, mid cap have not been performing well for a while. So again, when we start looking at kind of these longer term pictures, like for instance, if we look back over the course of the entire year, ARC's been a massive underperformer and momentum stocks have been a massive outperformer. If we start to see that turn through this analysis, that'll tell us it's like, hey, emerging markets and international stocks are really starting to capture inflows. We need to get that exposure in our portfolio and reduce domestic. So, this is just part of that process that we go through over time to kind of analyze, kind of where excess returns are coming from and what to kind of expect from markets, through time, and particularly, over the longer term. And this is where we start looking at things like excess returns in markets between markets. So value versus growth, mega cap versus value. That tells us if we start to see these rotations occur, where to start placing capital, if that makes sense.
It totally makes sense. Just a reminder for folks too, if you're wondering where all these data sets that Lance is walking through here come from, they come from SimpleVisor, which is a service that RIA offers to all investors of all stripes.
Yeah. This is for the DIY guy.
Yeah. What do we say? The layman's Bloomberg terminal, where you get virtually almost all the data just at a tiny fraction of the price.
Yeah, and we're really excited too. We've had a lot of people asking, because we talk a lot about credit spreads, and that data is really hard to get. So we've just been in conversations with Macrobond here recently about acquiring their data source, so we can start. And this will take us a little while to build out because we got to do all the math on our side. But if we can get this data set from them at a reasonable cost that I can afford, we're negotiating the price now, so no guarantees yet. But if I can get that data set, then I can create a whole page on economics and credit spreads and all the various outside factors that impact markets over time as well. So we're really excited about that if we can get that put together over the next month or so.
All right, good luck. I'll keep fingers crossed on that one. All right, well, let me move on here just in the interest of time. Okay, I want to talk about some of Trump's executive orders, but one of the things you get a hand of the guy is he is just getting stuff done right and left right now, and he's made a lot of declarative statements to a lot of people. I don't know if you saw his Davos speech, Lance, but definitely he's said a lot of things that crowd really didn't want to hear. I don't think Trump cared at all. But he made two declarations, more or less. He said, "Hey, look, OPEC, you guys gotta bring down the price of oil on your end, and Powell, you got to bring down interest rates." And a lot of this is people, reporters asking him, "Hey, you said that you were going to get inflation down and you're going to help the little guy with lower prices." I think this is Trump trying to deliver on that. So it was really funny. If I can find the clip, I'll put it in here. But have low expectations on that, folks. But he was asked yesterday by a reporter, hey, you're asking Jerome Powell to bring down interest rates. The Fed's independent. Do you think he's going to listen to you? And Trump just kind of paused for a beat, smirked, and said, "Yeah, I think he's going to listen." So we'll see what happens.
Uh, Powell listed in 2018. Remember, in September 2018, nowhere near the neutral rate, and by December and 20% lower in the market, Powell was certainly happy to listen.
Right.
So,
After he'd been called to the White House, he comes
yeah.
back and changes his tune. So will that happen again? Who knows? But here's where I'm going with this. So, Trump clearly wants to bring down prices. The day that we're talking here, University of Michigan's inflation expectation data came out. There's a pretty big jump in it. So, consumers are worried that inflation is not under control yet. And look, where I'm going with this is obviously huge open question, right? Is inflation tamed? Is it going to be stickier than people think? We talked a lot about this at your conference. So I won't, relitigate the whole thing. I do want to note one thing, and then I want to ask you about a piece you just wrote. So I just interviewed Michael Howell. He's the liquidity guy, right? He thinks that liquidity is peaking. It'll continue to rise for the rest of this year, and then the cycle will turn down probably for 2 years or so. He's got these liquidity cycles. But in Michael's mind, it's all about, he thinks about it almost less as liquidity cycles and more of debt refinancing cycles. And that because there's so much debt, and because at the end of the day, central banks' jobs is to keep that debt as manageable as possible, that they're eventually going to have to go back to QE to try to keep things manageable as debt has to be refinanced around the world right now at higher rates. He thinks you're just going to have to, figure out how to cushion the blow of that, whether through its lower rates, whether it's through more QE. So anyways, you have done a lot of thought about this. I know that you and your colleague there, Michael Leibowitz, you do think that over time inflation is going to get cured, and largely that it has to do with slowing economic activity, which you've already mentioned earlier is what you expect. You just recently wrote a piece on this saying, does money supply, deficit spending, and QE create inflation? I wanted to sort of set that context to be able to let you opine on this.
Sure. Yeah. No, I mean, this kind of really came from a conversation I've had recently, and I get a lot of questions about this. Like, well, the Fed's doing QE, and if the Fed goes back to QE, that's going to create inflation. And if we're printing all this money for the government, that's going to create more inflation. And the surging deficit, that's going to lead to inflation. Actually, there's no evidence that that's the case. And so in that article, we go through a lot of charts and graphs. As always, we always give you the analysis. You can do it yourself. But a good example, just taking QE as an example. So QE is just an asset swap, right? So all the Fed does is buy bonds basically from the banks. It credits their reserve accounts at the bank, so it increases their bank reserves, and then they take a bond off their books, and then the Fed holds that bond and then remits the interest payments back to the U.S. Treasury. So that's just the cycle. That's not creating more money. There's a really important thing you need to understand about money, which is all money is lent into existence.
Right.
We don't print money. And this is one of the big misnomers out there, is like there's some guy behind the printing press just cranking out dollar bills. If that was the case, we would never need to issue debt. Our debt would be zero. If we could just print money, our debt would be zero, because why would I issue debt if I could just print a dollar bill, right? But we borrow the money to cover our excess spending. So if you take a look at inflation versus the deficit, when the deficit is decreasing, which it did in 2021 to 2022, we had a massive reversal in the deficit because we weren't sending checks to households and doing those type of things. So once we stopped doing that initial infusion of capital into households, that's where we had that $5 trillion deficit. The deficit reversed. So if the deficit is reversing, economic growth is growing because we're having to issue less debt to cover our spending. Because as economic growth grows, we're collecting more tax revenue because you have more tax income from a strongly growing economy. So you don't need to issue as much debt. So in that environment, if the economy is growing strongly, you're going to get more inflation. So when the deficit's increasing, that means the economy is slowing down. We're not collecting as much in tax revenue. We have to issue more debt. And that is all why inflation is declining. Inflation is declining because of slower economic activity. QE, as I said before, is an asset swap. And if you take a look at from 2009, because that's where QE started, was in 2009, through 2020, before we started sending checks to households, the Fed was begging for 2% inflation. In fact, the majority of the time during 2008 through 2018, 19, we spent more time below 2% inflation than we did above it. Now, inflation moves all around relative to economic growth, but the majority of the time during QE programs, we had deflation in the economy because why were we doing QE? Is because we were trying to get the economy to keep growing and trying to create inflation. We were trying to get consumer sentiment up so they would go spend more money in the economy. And so we had a lot of this support going on, but it was not in areas that was driving, it wasn't increasing the ability for consumers to demand more goods. So we had about 2% economic growth. We had about 2% inflation, give or take. And that was the best we could generate. And this was one of Bernanke's kind of big conundrums is we're trying to get above 2% inflation. We want above 2% inflation. We just can't get there. And they were trying all these different measures to get there. But again, we weren't doing the one thing that creates inflation, which is to increase supply and demand. And so if I increase supply and I don't increase demand, I get deflation. If I increase demand and cut supply, I get inflation. And that's what we did in 2020. We had this massive boost to demand because we gave people money to spend directly, which we had never done before. That was a new thing. And the result of that was this inflation. The Fed didn't cause this. This was caused by the government sending checks to households. And one of the statements is that, well, the Fed's never do QE again because they didn't like the inflation they got. The Fed knows that inflation didn't come from QE. It came from sending checks to households and shuttering the economy. We're not going to have inflation like that again unless you do something to increase demand without increasing supply to the same degree. That's what creates inflation. So the whole article just lays out basically how inflation works, why a lot of these analysis that are put out there just simply don't have the factual data to back it up. And most of the reasons that people say interest rates are going up, why? Because they're going up. Right? They don't tell you why interest rates are going up. They say, oh, inflation is going to go back like the 70s. Why? We don't even calculate inflation the same way anymore. We have a different basket of goods that we use. If you take a good example, is you just take a look at the latest rental income index. It has declined. We just wrote our daily market commentary on it today, actually, on the website, realinvestmentadvice.com. But we have the new rental data update, which has just plummeted over the course of the last couple of weeks. That's going to show up in CPI in the course about the next 3 months. So again, there's all these factors you have to understand that you don't have to do a lot of work to get there, but you just have to understand basic economics and how it works.
Okay. So I just want to kind of make this relevant to the average listener here. First off, your point there about rent, the reason why you're making that point is shelter is what, 40% of the CPI calculation?
It's like 38% of it, yeah.
Yeah. So essentially, as shelter costs go, the CPI is going to go. And it's a very lagging indicator. And a big reason for that is your rent only usually comes up, changes once every year, right? So it just takes a long time for changes in rent to get reflected in CPI. So, that's an argument that we might actually see the CPI start to really come down over the next 12 months. Sure, it'll bounce around a little bit, but the trend should be down if shelter costs, are really beginning to roll over here. So, Lance, I think the key takeaway from your saying is, hey, look, even if the Fed goes back to QE, don't necessarily expect inflation to reignite because of that, for all the reasons that you just mentioned, right? And so Michael Howe could be correct. Both you and Michael Howe might be correct. The Fed and central banks might have to revert back to QE, but we might not see a resulting spike in inflation for the reasons that you mentioned.
Well, and again, just the very simple basis is the Fed's doing QT right now because they want to get their balance sheet down. If they're doing QE, it's not out of the goodness of their heart. They're doing QE to fix something that broke in the economy, right? Remember, QE didn't exist prior to 2008. There was no such thing as QE. This is all a new playbook since the financial crisis that we've actually never healed. There's a lot of assumption that we've completely healed up from the financial crisis. For example, we repealed FASB Rule 157, which was mark-to-market accounting, to help bail out the banks in 2008. They could just basically, they had mortgages on their books that were worthless. They just keep them at full face value. We've never put that rule back in place.
Right.
Because there's still a lot of debt sitting out there that's marked at full face value that's not full face value on these banks' balance sheets. So there's a lot of impairment that, when you actually kind of look back, we've never actually fully recovered. You take a look at the growth trend of GDP. We were growing at 3.3% from 1947 to 2008. We're growing at 2.2% now. You take a look at a lot of the retail sales data on a retail sales per capita level. We are far below the trend in retail sales on a per capita basis than we were back prior to the 2008 financial crisis. Full-time employment as a percentage of the population is at lower levels now than it was prior to the financial crisis. We've never really gotten back to normality of how the economy was functioning prior to the financial crisis, post the financial crisis, even with all of these monetary supports.
Yeah. I could go, I want to keep picking at this, but I can't given timing and what else I want to get to here. Real quick though, two things. One, to your point about, it's oftentimes not as simplistic as it seems because there's all this stuff going on, right? Michael had a really fascinating chart that he walked us through in his interview. And folks, if you haven't watched it, I highly recommend you go watch that after you watch this. But basically showing that there was a lot of conspiring between Powell and Yellen over the past several years, that even though the Fed was quote unquote tightening, right, raising interest rates starting QT, the actual net liquidity impact was still positive through actions like draining the reverse repo program, draining the Treasury General Account, the BFTP. So, even though we're thinking, oh, they're draining liquidity from the pool, they really weren't, right? So, a lot of this stuff too, you got to be very careful. And you've always said, be careful about, making your investing decisions based on the headlines. But there's a lot going on back there behind the scenes that impacts where things are going. All right, and then last thing, again, just to make it really relevant for the average person, QE in and of itself may not lead to inflation, meaning I'm going to the grocery store and prices are higher, right? Yep. I think you would say, though, that QE does lead to asset price inflation.
Oh, absolutely.
Yeah. So things like the wealth divide get made a lot worse by QE.
Yeah. No, and look, and I've said this before with you on the show, and Ben Bernanke in 2010, he specifically made that connection. He was giving a speech when we had done QE1. When QE1 ended in the summer of 2010, the markets declined about 20%. And the Fed stepped in and said, this was Ben Bernanke at the time, says, we're going to restart QE. This was at the September Federal Reserve meeting. He says, we're going to restart QE. We're going to do about, I think it was $1 trillion of repurchases. And then he laid out the reasons why. He said, while our goal is full employment and price stability, we realize, and I'm paraphrasing here a little bit because I don't have the exact quote memorized, but we realize that what quantitative easing does is boost asset prices, which lifts consumer confidence, which supports economic growth, right? This is the whole wealth effect.
Wealth effect.
And he acknowledged, and this is where everybody immediately said, oh, this is the Fed's third mandate. The Fed's supposed to have two mandates, price stability and employment. That's their whole job. They actually have three now. And that third is creating asset price inflation, creating that wealth effect to support consumer confidence. So yes, when the Fed does that, absolutely, it boosts asset prices because the banks get the reserves. And then the question becomes, as the bank, what do I do with those reserves? I have a couple of choices. I can loan those reserves, and this was always the intent. What the banks were supposed to do was loan those reserves to Adam to go buy a house, right? So I loan Adam money for 30 years, and back then it was a 4% mortgage, whatever it was. Or I could loan the money to a hedge fund for leverage. I could help hedge funds leverage assets, and that, loan it to my prop trading desk for management there. And so, yeah, it finds its way back into the financial markets, which is why we've had these outrageous returns in markets. And again, I showed that table at the conference, about the excess returns of the markets over economic growth and dividends. And I put out this entire table going back to 1948, showing if you want to estimate what your forward return is on the markets, it's GDP growth plus dividends. So, and again, the data supports that from 1948 to 2024, there's a very high correlation to that. Between 2009 and present, we have increased those returns by almost 50%. So we went from 8% returns to 12% returns in the last 10 years. And that's a function of all that QE money finding its way back into the financial markets.
All right. This isn't today's rant, but I did do a little mini rant on X the other week, and you've just reminded me of it, Lance, with this wealth effect. I started my career on Wall Street, and one of the things that just never sat right with me living in Manhattan was there was this sense of we all have to protect the bankers' bonuses because they spend that money in the city, right? Mm-hmm. And so, it was just sort of taken for granted by kind of everybody that the bankers had to be really well paid, right? Because we're all going to benefit from it. And I just remember thinking, like, who made these guys gods? Why are these guys such a protected class, right? And it's this sort of twisted logic, right? That if we make sure that the privileged class gets even more privileged, they'll hopefully be generous, with us in terms of their spending. It just felt so wrong. But you're basically saying that seems to be our central bankers' mandate nationwide, right? Let's reward the already rich. And hopefully, as that trickle, I guess this is trickle down, right? as their spending trickles down to the bottom 90%, we should all be more grateful, right? There's something about that really does not stick well with me.
No, and look, I think the goal of the Fed is like, look, they say if we increase the wealth effect, that should, in theory, impact a very broad swath of the economy, right? Because people have a 401k plan, they see their 401k plan going up in value, so they go spend some more money. I feel better about spending, right? If my value of my 401k, my retirement's going down, I maybe don't feel as confident, right? I maybe start worrying about losing my job. People have investment accounts, they see that go up. And this has been one huge benefit. One of the reasons that we have had, this kind of economic growth and more sticky inflation over the last couple of years, and something that wasn't well factored in because we hadn't had it for so long, was 5% money market rates. Mm-hmm. Because all of a sudden, people that did have some savings in their account, they were getting 5% on their money. That gave them more money to spend. So it kind of helped perpetuate that spending in the economy because they were getting this 5% interest on whatever savings they had.
Oh, and it's a stimulus for sure. It's just a stimulus to those who have a lot of money in savings. Yeah, but yes.
Well, even for people that didn't have a lot of money, they were spending money and they had some money in the savings. Maybe they had $5,000 in a savings account, right? And they saw more money coming in, every month from their interest rates. It just makes them feel better, right? So they're a little bit more inclined to go spend money. So the theory is that the wealth effect would affect everybody in one shape, form, or manner. But the problem is, and as I know, 25% of Americans actually contribute to a 401k plan. There's very small amount of money really relative in 401k plans versus other assets, right? You take a look at savings rates for the average American, the bottom 8%, can't meet a $500 expense. Those type of, we know those stats. Those studies.
We have net negative national savings right now, right?
Yeah. So we know that impact. the bottom 40% of Americans, they spend 100% of their paycheck every week or every month or whenever they get paid. They spend 100% of that. So whatever they get coming in, it gets spent because they're just trying to make ends meet. The top 20 to 30%, they're the ones with the excess savings. They're the ones with the excess spending capacity. So to keep economic growth really going, you're relying on a smaller percentage of the overall wealth, right, to drive that economy, because we're right. And to your point, we're kind of depending on those guys to go spend a lot of money in the economy to keep the kind of keep the ball moving, so to speak.
Yeah. So, look, I I totally get that it's never going to be an equal distribution, right, of wealth across the full spectrum of people. In fact, I just tweeted about this yesterday. I was going to bring this up in the conversation. So I was kind of shocked. I just saw a stat yesterday that the bottom 50% of households only hold 2.4% of US wealth. Right? And I got to say, when I saw that, I got angry. I tweeted out about that. Um, Now, a user on X actually did say something that I've been really chewing on, where he said, well, it's the Pareto principle, right? The 80-20 rule, right? So, if you apply that to wealth, you would say, okay, well, 20% of the households will have 80% of the wealth because that's just Pareto. And then if you go down to the next 20% and they have 80%, you actually, it kind of explains why the bottom 50% holds very, very little, right? Now, we could talk about, do we want a society that where half your population isn't basically, subsistence living, but I don't want to fully get into that story here. But I want to agree with you and then make a counter, which is, I agree that the top half is always going to have a lot more than the bottom half in a meritocracy, right? In a capitalist system, right? I just think that we should be spending our focus on saying, okay, how do we make it easy for true capitalism to happen, where contenders can come up, people can change station if they work hard, all that type of stuff, and to be having policies that just directly and immediately reward those at the top, saying, hey, we just hope that'll trickle down everybody. To me, that feels really unfair, right?
Well, so you tried that, right? We sent checks to households, and what'd you get out of it? You got poorer households.
I definitely don't think you should be doing direct like that at all. I'm just saying, I don't think checks directly to the top 1% is the solution either.
Well, yeah, but we're not actually doing policies directly to the top 1%.
But QE is kind of like that, right? If we're going to create asset price inflation, they're going to benefit way more disproportionately.
No, that's not the case. That's where you're wrong. Everybody has the ability to participate in the capitalist system. It's whether or not they choose to do it. Look, I'm talking to my daughter right now. She's just, she's finishing up school, getting ready to go out in the world, and her very serious boyfriend, they're talking about the next phases of life. They're sitting down, they're having their budgeting discussions about, well, she's going to make this much from her job. He makes this much from his job. What's their budget look like? So they showed me their budget. No savings in there. They're spending right now. It's going to require them to live their lifestyle they want to live. They're going to spend every cent of it. And it's not that they didn't think about the savings and investing part until I brought it up. It's just, that's not a function of what we teach most people. So there are plenty of stories from, people that have come to this country with 2 nickels in their pocket, got no assistance from anybody, and built big businesses because they worked hard, they took advantage of the capitalist system and did it. The problem is that most people don't do that. And when I say most people, that's 80% down, right? You take a look at the top 20% of income earners, those are your business owners, those are the people that are driving and taking advantage of the capitalist system. They're investing in the capitalist system. They're buying real estate. They're doing all those type of things. They're prioritizing saving and investing over consumption. Those are the people that benefit from it. Whenever you try to introduce something, it's like, well, we need to do something to help this group of people. That's socialism. Right? That doesn't work. That destroys your whole capital system. And
I disagree. I mean, I agree. I
know you agree, but you have to think about what you're saying at the same time, is because you can't, we can help people at the bottom. The bottom 20% can join the top 10% of income earners, right? But you have to do the things that are necessary. We just assume that these people are just unredeemable. And that's not the case. Every society has rich and poor. You're never going to fix that. That's socialism. That's communism. That's oligarchies. That's capitalism. You're always going to have rich and poor. You are not going to get around that because there are always some of those. There are always people within in a society, those that are going to work hard and those that aren't. And you're not going to get past that. That's just human nature. But we have to figure out a way. To answer your question, we can help elevate those bottom 20%, those bottom 30%, those bottom 40%. We can elevate them and we can bring them up in society. We just have to teach them how to make choices of saving and investing over consumption. But look, I saw just a good example the other day. I was at a coffee shop picking up a cup of coffee for my wife, and over in the corner was this gentleman, and not very well dressed at all, drinking a cup of coffee, but had a brand new Mac computer and an Apple iPhone. And this is the society that we've created about consumption, and we have to have all these things. Ask your kid whether a cell phone is a necessity or a want, right? And you tell me what her answer is.
So look, I disagree with nothing that you've said here. I want to go back to my point though, which is I don't think the answer is giving the lower classes handouts, right?
Right.
I don't think, but I also don't think it is socialism for the rich in the same way of like, oh, you've got money. I'm gonna have a policy that rewards you, and then we're gonna hope everybody's fine. What I would rather see are things like,
okay, so how does QE reward the rich directly versus anybody else?
Because it creates asset price inflation.
Okay. I make $20,000 a year. I invest $1,000 of my annual income in the stock market. I benefit from QE just as much as the rich guy. Right? I don't benefit as much because I don't have as much to invest. But QE doesn't segregate between rich and poor. It only segregates between those that invest and those that don't invest. That's your only problem you need to conquer.
So let me think through this. So I'm thinking of things like I'm trying to think of what would I like to see. I'd like to see maybe like lower taxes, right? Everybody benefits from that. Now the rich are going to save more money because they earn more, right? But everybody basically, to the extent that they're working for money, they're better off on that, right? Whereas if I say basically, okay, I'm doing something that if you have no money, nobody's benefiting from. If you have money, great, you're going to be even better, right? And it also provides incentive for people to go out and earn more, right? Because hey, I'm going to keep more of what I earn, right? Now I sort of understand what you're saying, which is like, well, your QE provides an incentive to save money, but I got to think about that a little bit more because it's a direct benefit to the already advantaged, and that's what I'm trying to get my brain around.
No, it's only a benefit to the advantage, right? Because you're just saying that this person's advantage, so they're getting a benefit from it now. But let me go to an example. A guy comes over from India or China or a vast number of other countries that has no money, and they start a business here, and they're just boot scraping it, right? So they're in the bottom 20% of society, right? So he's not advantaged, but he builds his way up to where he's now making $5 million a year in income and now has a lot of savings and can invest in the economy and can benefit from the markets and everything else to a larger degree than he could when he was in the bottom 20% of the economy. So how is he disadvantaged over one person or another? See, we just look at people that say, okay, you've got a lot of money, so you're just advantaged. A lot of the people that got that money, yes, some of it inherited it, right? But there's a lot of people that are wealthy today because they bootstrapped a company. And look, a lot of these people are my clients and that have bootstrapped a company from nothing. They built it from scratch and they wind up selling it or whatever they did down the road, and they built their wealth. So, we don't want to just bucket them and say they've got an advantage that somebody else didn't. But what the advantage they had was is they had a vision. They took advantage of the capitalist system. They saved, they invested, they took risk, they scraped by. I told you the story about the guy that started the Bananas, the baseball team,
Right.
right? And he's like, he was on the verge of bankruptcy, and his wife said, "We're going to move to the crappiest side of town. We're going to get a terrible little apartment, and we're going to make this thing work." And now he's very, very successful with the Bananas, and he created this whole business, but from nothing. And so this is the thing we've got to be very careful of. These narratives of, oh, well, the poor, they're so disadvantaged, blah, blah, blah. The rich, they have all this benefit. And you got to be careful with that, because you have to understand for each person how they got there. Look, I told you my story. I lived out of my truck for 3 years. Now I can take advantage of the capitalist system. It took me a long time to get there. It didn't happen overnight, but nobody gave me anything. I built everything from scratch. So this is where we've got to be careful. We have to understand what capitalism is about. It's not the capitalist system is predatory, and
Yeah.
you will either succeed. It's the strong survive and the weak will perish. That is capitalism at its best.
So
And,
here's the issue I have with this, because
and
again,
that
I'm not disagreeing with what you're saying. We're like at 98% we're there, right? But like QE, I don't necessarily think is capitalism, right?
no, I'm not a fan of QE,
I feel
right?
like QE, here's an analogy. I feel like QE is going out into the Serengeti and giving the lions a bunch of extra food, right? You're the apex predator, you're the strongest, I'm going to make you even stronger, right? And hey, that's the benefit of being an apex predator. And sure, if you can work hard to become the apex predator, you're going to get extra steak too, right? But it's monkeying around with the natural Darwinistic process. That's the problem I think I have with it.
I don't disagree with that statement, right? Because I'm not a fan of QE either. I don't think, look, personally, financially, I don't think we should be doing QE. I don't think we should be doing bailouts. I don't think we should be doing anything to that nature. We shouldn't be sending checks to households. If you want the economy to function and you want valuations to be right, you want markets to trade where they're supposed to trade, where valuations should be, then you've got to take out all the excess influences. Absolutely agree with that. But at the same point, we also don't want to move ourselves into socialism,
No,
trying to,
you don't even need to go there because I'm not trying to do that.
I'm just saying, it's got to be, we just got to be careful with this. It's
Okay.
a slippery slope. Once you start going down this slope, it's very slippery. And you start bucketing. My problem is when you bucket people and say, everybody in this group is advantaged, everybody in this group is disadvantaged. You can't do that, because everybody is there's a different story for every single person in that bucket.
I don't disagree, and that's why I spent the time talking about the Pareto principle, where I've actually thought about that more, and I'm like, actually, you know what? Like, you're always going to have a really big mismatch between the bottom 50% and the top 50%, even the 50% and the top 1%, right? I mean, it's a power law, right? It's always going to be a power law. In a fair system, it's going to be a power law, right?
Even in an unfair system, it's going to be that. Like, you have people in every system.
Right. But even, yeah, if the unfair system's probably even more skewed, but still, even in a fair system, you've got to expect this power law. Okay. And just to be super transparent, Lance, I was writing myself in there. All right, should I cut this QE rant that Lance is going on right now with question mark? I think we actually brought it to a point where I'm going to leave it in.
Okay.
Because I think at the end of the day, we both agree, both that capitalism, has its warts, but it's the best system we know of. It's not useful to bucket anybody or to have narratives that aren't constructive. And you always want to have incentives, right? You always want to have both the incentive and the ability, I'll say, for somebody to improve their station, right? Whether they actually choose to do so or successful in doing so, different story, but you want to have those in place. What you don't want to be doing, though, is distorting the natural capitalistic forces, which is something I think we both agree that QE does.
Absolutely. Okay. And that, I think that is the key takeaway, is that the deformation of capitalism is the thing that we need to focus more on.
Okay. Which again is why I don't love giving the bankers all the money, but that's put my little bow on that.
What does that say? That in a revolution you hang the bakers and kill the lawyers, something like that?
I don't know. They all go. Yeah.
They all go.
All right. There was a chart you have. I'm just going to mention it,
Mhm.
but it's related to what we're talking about. You put it out on X. There's increasing data that consumers are running out of savings. Anything
Yeah.
you want to say about that real quick?
No, look, it just goes back. No matter how you slice the data, right? If you're, for instance, you brought up the Michigan inflation expectations had a big jump. If you take a look at the data, it does that about every other month, and then the next month it plummets, kind of back to the trend. So it has these really weird spiky data issues to it. But at the end of the day, it's all about consumption. The economy is 70% consumer spending. And so if consumers stop spending, the economy is going to slow down, demand declines. If demand declines, companies lay off more workers, they stop producing as much. That reduces, they have inventory left over, so to reduce prices to get rid of that inventory, which leads to disinflation, so forth and so on. But that's how you wind up in recessions. So watching what's happening with the consumer, considering they make up such a significant portion of the economy, is important. And this is really important here because there's a lot of talk right now. CEO confidence is shooting through the roof right now because of the election of Trump.
Right.
So a lot of these policies he's putting in place, kind of America first, these type of things. In fact, I had an article coming out on this on Tuesday, is very bullish for CEOs. They're very confident. NFIB Small Business Index has surged to near record levels. That went from 91, which was one of the lowest levels on record, going back to like 1986, just a couple of months ago, to 105 in the last two reports. That is all great. Sentiment is awesome. Everybody's excited. But if we don't see things actually translate to actual consumption, it doesn't matter. Businesses, 15% of GDP is comprised of business investment. That's CapEx. But if they don't, but they're not going to go, while they're very optimistic about spending CapEx, first of all, 15% doesn't support the entire economy, 70% of consumption does. But if they don't see the consumption side, the demand, they're not going to spend the money on CapEx. So sentiment's great until you don't see the evolution of actual demand within the economy, and with consumers running out of money, that's going to be becoming much more of a challenge. Again, another one of the reasons we're kind of being a little bit more cautious about this year is we think that consumer strain is going to continue to pick up as we go further into the year.
Yeah, I was going to say that could be the uh-oh moment, where the market realizes, oh, wait a second, we've been planning this big party, but the consumer isn't showing up to it, right?
Right. Yeah.
Yeah.
Exactly.
Real quick, just because you mentioned it, I understand everything you said about, hey, if consumers start spending less, that's disinflationary.
Mhm.
Just talk for a moment about those that have the concern of stagflation, right? Which is kind of the worst of both worlds, which is where prices are still persistently rising, yet you have sort of recessionary conditions in the economy.
So stagflation is always kind of a very interesting topic, right? It gets thrown around a lot, and then people go, "Well, back in the '70s we had stagflation." We really didn't. So what? So first of all, we need the true definition of stagflation. Now, normally, what people do is they give you two of the three ingredients of stagflation. They say, well, it's high prices and low unemployment. That's that gives you the mix, right? Or slow economic growth and high prices, and so that's your stagflation. That's not the definition of stagflation. Stagflation is slow economic growth, high unemployment, and rising prices. Well, we can have slowing economic growth, but do we have high unemployment?
No, or at least not yet, but no.
Not right now, right? We've got very, very low unemployment. We have declining prices, not rising prices. Yes, prices are higher than they were last year, but they are declining from where they were at the peak when we had 9% inflation. We're obviously down to 3% inflation. So
They're disinflating. They're not declining, they're disinflating.
Right.
Yeah.
So if the economy slows down and you start getting high unemployment in this environment, you're going to wind up ultimately in a recession, not stagflation. So you're going to just get outright deflation, not stagflation. So it's always important that when you talk about stagflation, you include all three components, because most of the time they avoid the unemployment version of that kind of critical factor of what's going on. So it's you can't have stagflation if you have low unemployment. So that's really so employment's going to be the thing to really keep a watch on. And it goes back to the hope framework and everything else that you've discussed in the past. But the hope framework is going to be really critical to what the outcome of the economy is.
Okay. And speaking of the Hope Framework, that's developed by Michael Kantrowitz of Piper Sandler. Michael's going to be on the program, I think, in like a week. So we're going to get an update from the horse's mouth soon. All right, Lance, I'm going to start wrapping it up. First, we'll get to your trades in just a second. First, you mentioned it very briefly, but I just wanted to comment myself on how much I enjoyed your event in Houston last weekend. Great time with you and the RIA team. That you put on a great event, but great time with the people that were there. And if you're one of the folks that attended, thank you. And if you're one of the folks that attended and came up and talked to me in person, thank you. I met so many great people. They had so many nice things to say about what we're doing here, Lance. But more importantly, they gave me lots of suggestions on, speakers I'd like to see, topics I'd like to hear, et cetera. But I thought you guys did a great job and I had a wonderful time.
Well, that's great. We're already starting to plan for next year. So we're going to potentially add some even more stuff for next year. So really excited about that. So if you didn't make it this year, we definitely want to have you next year. It'll be in January. Don't know the exact date yet, but it'll be sometime in January. But fly down, come hang out. If we get enough people coming in from out of town, maybe we can even put together like a speakers dinner the night before just for our out of town crew to go have dinner with you and me and Mike and our guest speaker, whoever it is, and yourself. So
I think it'd be great. Danny was telling me you guys might end it next time with a happy hour where folks can just stay around and talk more too, which I think would be great.
Yeah. So that's what I said. These are all things that we're kind of tossing around right now. So yeah, looking forward to it.
Speaking of dinner too, folks, so Lance took me to dinner the night before with his wife, who I must say is absolutely lovely. I don't know how you pulled it off, Lance. But
hey, you and I both married way above our station, so
I think we're both charter members of that club.
exactly.
But yeah, I can attest that Lance, if he picks stocks half as well as he picks spouses, he's going to be one of the best capital managers out there.
Thank
Yeah.
you.
Yeah, no, great time. And I will say too, Lance, he treats his wife very well, as much as he abuses me on these weekly videos, he treats his wife the way that a husband should. So good on you there, Lance.
Thank you.
Secondly, just two other events to put on folks' radars. One, we've got so next Friday, so a week after this video comes out, more or less, Substack is doing a big event with the top financial Substackers. They've invited me to participate in that. I'll be interviewing Danielle DiMartino Booth and Kevin Muir, the macro tourist. And so those should be great discussions. You can only watch them on Substack. So if you're not yet subscribed to my Substack, it's free. Just go to thoughtfulmoney.com, hit the newsletter link at the top of the website. You can sign up for that Substack there. And then you get alerted next week before these live presentations go out. Secondly, I think I gave a nod to this last week, Lance, but just in case I didn't, folks, the Thoughtful Money Spring Conference has now been locked in stone. We're going to do it Saturday, March 15th. The lineup is already awesome. I've shared a number of the names of the faculty. There are more being added. In fact, there's a number that have been added since I put out the original announcement that I'm not going to announce yet. I'm going to kind of trickle them out over the next week or two, just as I get full confirmation those folks can attend. But it is a great lineup this year, folks. So already we have Lacey Hunt kicking it off for the keynote. Everybody who's been before knows how amazing that is. Many say that's worth the price of the event in and of itself. But we've got both Luke Groman and Brent Johnson. They're not going to be debating each other. They're going to be separate presentations, but you are going to get to hear the latest on what those two think back to back. We're going to have Michael Howell and Darius Dale, two of the names that get requested the most on this channel. They both recently appeared here, but the conference isn't for 2 more months, so we're going to get very important updates from both of them then. We also, from an international perspective, we're going to have Louis Vincent Gove from GovCall. We're going to have Stephen Bavaria there talking about income investing, giving us, he's got a number of new tickers to share with us. Melody Wright will be giving a housing market update. But we also have a number of other names that I think you folks are going to be really interested in. I'm going to keep you waiting in suspense for those for at least another week or two, and again, until I lock those things down. But it is going to be a great, great event, and I think very timely as well. All right, so Lance, trades. What trades have you guys at RIA made over the past week?
So none over the past week, and we had talked about over the last couple of weeks. So as markets were kind of approaching that low point, we talked about that we were kind of rebalancing our portfolio a bit. We had bought Palantir into the portfolio. We added to GE Vernova. A couple of our other positions in that area. We had trimmed back on energy stocks because oil prices gotten very extended. So mostly, that, and then last week we bought Procter and Gamble because stables have been under a tremendous amount of pressure. Procter and Gamble just reported really good earnings this week, and so that stock was up about 4%. But overall, we're not doing anything major right now. We use that weakness in the market to add to positions in our portfolios, and kind of rebalance risk a bit. But now we're kind of waiting to see what happens next. Markets are a little bit extended here. Nothing to be overly concerned about at the moment. No reason to go take a bunch of risk reduction. But again, we're kind of waiting to see if the market just kind of digests here and then starts moving higher, or if we start seeing more of a kind of a corrective action. Remember, in February of last year, we were talking about it. We were here on the show talking about how markets were extremely overbought, extremely extended. We expected a correction. We got that in April. It took a little bit longer to get there. Mm-hmm. We're not there yet, right? We don't have those type of conditions, but I suspect if this market kind of rallies again into February, that we may be talking about a 3 to 5% correction sometime in April. So we're kind of watching the market develop and two, right now the markets are digesting this kind of flurry of executive orders. So again, we don't really have, and a lot of this stuff, it sounds great. It's great headline stuff, but doesn't really mean a whole lot. A good example is like, the order on deportations. People forget that when President Trump took office the first time, a lot of the media was going, well, he's inheriting a really great economy. There's, he's got this really great, kind of backdrop to walk into. And that was all due to Obama. Well, everybody forgets that Obama was the biggest deporter of illegal immigrants in recent history. He deported 5.4 million people, and it didn't crash the economy. So, there's a lot of these kind of headline rhetorics that are out there. It's like, oh, this is going to crash the economy. And again, great stuff to kind of latch onto. But there's not, and the same thing with tariffs. Tariffs are going to cause all this inflation. Well, he just announced over the days, like, I'm not really hoping to use tariffs with China. I'm hoping we can just negotiate something out. And the tariff was not 100%, it was 10% right now. So, kind of what's talked about, what gets into the media and gets people scared about markets or inflation or whatever it is, reality tends to be something dramatically different. So it's why it's always important. Go back to the data. That's why if you don't go to our Substack channel at Lance Roberts, I post all of our work there, all the charts, all the graphs, all the correlation analysis, everything that's there for you. So if at least you've got some data to work with to say, okay, what am I concerned about? And has that been the case? Because just as us managing money, trying to figure out what to buy in our portfolio or what to sell, we don't want to just do it based on emotion, right? Emotion leads us to make really bad decisions in terms of our investing strategy. So we want to focus on the data and then build our thesis around the data and understand about where things are coming. Now, obviously, if something changes, we're going to change. If Donald Trump announces tomorrow that he's going to send $1,500 checks to households and do a $500 billion or $1 trillion stimulus bill, infrastructure bill, then we're going to sell bonds and we're going to buy a bunch of equities. So that will change the dynamic of the economy because of supply demand imbalances. But this is why it's really important to pay attention to what is said versus what actually occurs, and then respond to what historical data says will occur in that environment. Because most stuff you hear right now in the media is just assumptions. There's no factual basis behind it.
Yeah. And what you're doing, Lance, is you're making an excellent argument for why most people should be working with a professional financial advisor who has a framework, who has a data-driven process, so that you're not just getting winged around by the headlines of the moment or the emotions of the moment or whatnot. All right. Well, look, I had a rant scheduled. I had jury duty this week. A couple funny stories coming out of that. Not enough time. We already kind of pre-ranted on the whole wealth effect thing. So I'll try to save this to next week if folks are interested.
Wait, just tell me what the topic was.
Oh, what type of trial it was?
No, what was the topic of the rant that you wanted to get into?
Oh, it was jury duty.
Oh, jury duty. Oh, I will definitely say that. I hate jury duty.
Yeah, I was assuming you were going to have a lot of opinions on that. Yeah, exactly. Okay, so anyways, Lance, you were talking about having a framework in place to make better decisions. Folks, if you think one of the better decisions that you can make with your life in 2025 is to watch Lance Roberts on this channel week after week, please let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. As a reminder, if you would like some help from a good professional financial advisor who takes into account all the macro details that Lance and I have talked about here, if you'd like them to provide some help with you in terms of coming up with strategy on how to manage your portfolio or maybe even help you manage it, highly recommend that you consider reaching out to one of the financial advisors you see with me on this channel week after week, perhaps even Lance and his team there at RIA. To schedule a free consultation with them, just go to thoughtfulmoney.com, fill out the short form there. By the way, when you're at thoughtfulmoney.com, go to thoughtfulmoney.com/conference and sign up for our spring conference that's coming up again on Saturday, March 15th. Do that now while we're offering the early bird price. That's the lowest price we're going to be offering on it. I think it's something like a 38% savings over full ticket price. And a reminder, if you are a premium subscriber to our Substack, you get an additional $50 off the ticket price. In the email that I sent out the other day announcing the conference, you'll find at the bottom of that email, if you're a premium subscriber, the discount code to use. So make sure you use that. I want everybody to get the lowest price for the conference that they can. All right, Lance, always great talking to you, buddy. It was great seeing you in person. I hope we get to see each other in person again before next year's Houston event. As usual, I'll let you have the last word.
No. Again, it was great having you here. Really enjoyed it. Looking forward to next year. But look, just the whole bottom line of our whole conversation is, look, there's so many emotionally driven, charged headlines. People have agendas. People have biases, and particularly in the media. Some people love Trump. Some people hate Trump. Whatever it is. Just be careful of the headlines when it comes to your investing, and just focus on the data. And again, go to our Substack channel at Lance Roberts on Substack. Go to our, watch our YouTube channel if you want. We put out a tremendous amount of data every single day in terms of daily market commentary, articles, blogs, et cetera, just going to the roots of, this is what the data says, and this is why we're coming to our decisions. It's based on this data. And agree with it or not, doesn't matter. You're going to have your own opinions. Just make sure that you have a view that keeps your emotions out of the issue of your investing. And that's why, recently we produced articles on how gardening, applies to your investing, or your New Year's resolutions for investing. Those are the things you want to focus on. And kind of forget about a lot of this other stuff you hear in the media, because it really kind of gets you off of the purpose of investing, which was to make money to start with.
Yeah, I totally agree. Very well said. Good concluding point. And I do want to congratulate you and the RIA team, Lance. You guys are more generous than I think anyone I know of with the data that you share out in the public realm, but also with the decisions that you guys make on that data. You're basically just saying, look, here's a boatload of data. Here's all the things that we're looking at. This is what we think is important. This is what we're doing. I know you do that to try to help as many people as possible, and also model, right? Like, hey, if you're going to manage your own money, great. Just make sure whatever you're doing is better than what we're doing, right? Or, hey, if you want help from a financial advisor, most people probably should get one. Get somebody who's at least as good as us. What they're doing should at least be as good as what we're doing.
Well, I appreciate that compliment, and we're always striving to be better. I always feel like it's never good enough. So That's why we're always coming out with new tools and new stuff like with Simplivisor and those type of things. It's always like, we can do more. And because again, I think, Adam, one of the important things is like when you talk about thoughtful money, right? The goal of the channel should be to provide good, thoughtful analysis to help people grow their wealth. And again, this goes back to what you and I were talking about earlier, kind of debating on, is that, we kind of bucket people. It's like, well, these 20% of people, these 40% of people, they're just stuck there. And you don't have to be. We don't teach, how to invest. We don't teach people how to save. We don't teach people how to, live below their means. And just understanding. And I have this email that I send to people all the time that, come from you, they go to your channel, they send us the email, hey, I'm 25 years old. And I'm like, forget all the other stuff, turn off YouTube, turn off the television, and just start saving money.
Right. Earn and save. Yeah. Investing will take care of itself when it needs to, but earn and save first. Yeah.
But that's the thing that gets you from the bottom 20% to the top 20%. And everybody, everybody's never going to get there. There's always going to be 20 and 20. But you have the ability to get yourself there, but you've got to be willing to make the sacrifice, have the patience, look out long term and say, look, I know what I'm doing today is not going to show any fruit for the next 5 years. But in 5 years, I'm going to look back and look how much further I am. And 5 years after that, look how much further I am. And anybody that's built wealth will tell you the same thing. But a lot of times just, we as individuals, we just look at our Snapchat or our TikTok or whatever it is. My MySpace page. I don't know if that's still around or not anymore, but
you're dating yourself, brother.
Yeah. And we compare ourselves to everybody else. It's like, I want that now. Right. And we've got to get out of that mindset if we want to build wealth. And that's the hard thing to do. But that's why I'm always trying to develop new tools and new things and put out the research and the data out there. So, we can lift these people up. We just have to give them the tools to work with.
Absolutely. And that's why I see you as a brother in arms, Lance, is, we're all about trying to foster forward mobility, no matter where on the spectrum you're starting. We think most people do and should aspire to improve their station, and we just want to help as many people as possible improve their station by as much as possible.
And Adam, maybe that's something that we need to think about too. When you and I have these discussions every week, they're pretty highbrow, right? I mean, we're talking very elevated topics that really, for the vast majority of Americans, they really don't care about because they don't understand. It's like me talking to my wife about my business. I mean, immediately her eyes glaze over and
right.
And I love her to death, but it's just not her thing, right? And so maybe we need to spend a show just going to the very, very, very basics of, how to build wealth, how to start, the sacrifices you need to be willing to make, and maybe that'll be boring. I don't know. Maybe you can get some feedback from your channel. But I think there's something there that I've never figured out how to really tap in to that educational side, but maybe you can help me figure it out.
Yeah, well, first off, folks, let's get some feedback. What do you think of that idea? I'm going to guess for many of this viewers, there's some percentage that would say, yeah, I'd love to see that too. But I'm guessing a lot of them are probably saying, hey, there's a lot of people in my life I'd like to share that with who aren't coming on YouTube and watching hour-and-a-half long discussions like this, right? But who want to learn how to, build some wealth, right? But just give it to me in digestible nuggets that a non-macro wonk, can process. So, folks, if there's enough interest in that, let us know. Lance, that it could easily be it's something I'd love to do. And if an initial video is well received, who knows? Maybe there's a channel in there that's sort of thoughtful money for the person who only really thinks about money once in a blue moon, but wants to have an online resource to go and learn some of these fundamental concepts about. So, great idea. All right, folks. Well, we'll leave it there at that, buddy. Thanks so much for another great week. Everybody else, thanks so much for watching.